Today, folks, your time is running out, baby. We're going to be talking about this peculiar circumstance that, yet again, very few people are talking about. And I don't know if it is just a peculiar speculation leading into a potential, fizzle out. There's a lot of speculation around what's going on with interest rate cuts, but I promise you, there is a lot of action in different aspects of the market that are just not being discussed right now. And I've been bringing this up on my channel, obviously, as we've been reviewing the portfolio. My gangstas, we got Looney out there. Sup, Patrick? We're going to be talking about you specifically, of course, when it comes to RioCam, baby. But taking a look at the portfolio, I was shocked talking to my parents, some other people, and it's just crazy just within the last month or two how much certain aspects of the market have changed. My portfolio finally adjusted, because it wasn't adjusted when I was talking about it yesterday, is well over the 320 mark, which kind of blows my mind, because it's not like I've been crazy contributing to this portfolio as much as I have been just focused on trying to always find that next position. Because what I do is I don't really trade with invested capital. I primarily just try and find what I want to buy, and then I just work and I try and use the working income to fill those positions out. And I really stop paying attention to like the rest of my portfolio. So when I see that I'm getting these wicked gains, I'm always like, where did this come from? Because it didn't come from contributions, right? But there again, there's no real surprise. I mean, when you take a look this week, I mean, the S&P 500 popped up 3% here, folks. How much money do I have in the S&P? I don't even keep count of it. Something like $170,000. So when the S&P moves, 1%, we're almost talking about a couple G's difference in my portfolio, right? Kind of keep forgetting how that snowball effect really starts to compound in the portfolio. SCHD was up 1.2% this week, VDY up 1.3%, and obviously our triple leveraged real estate ETF up 10.4%. I kind of want to zoom out on these individual positions first and foremost. Let's take a look at how they've been performing over the year, but then we're going to dive into the TSX. And then I really specifically want to talk about what's happening in Canada that obviously I'm betting severely on that is going to happen in the US. And the question is this a new trend? Is this something that is going to take us to a skyrocketed level, or are we already starting to see the end of the rallies in these specific sectors, especially when it comes to interest rate sensitivity? Then we're going to answer some of your questions, comments, which you guys have been posting on my videos. We'll talk about PPCE and some other interesting outlier aspects of the market that are obviously intriguing. And then finally, I want to get to know you a little bit. I really want to get to know you. And you guys don't know you as well as I do, because I see all the stats at the back end of my YouTube channel. And after a decade, we kind of celebrated our little decade video of investing. 5 years deep into this YouTube channel, a hair cut that needs to be done. We're going to kind of break down, a little bit about you guys, your age, what channels you're interested in, and just stuff that I always find super intriguing. But firstly, obviously, what's going on, brother? We got Skiz in here. We've got Pavinder Dulai. I hope I'm saying that right. Web surfer. Sup, you degenerates. Being as degenerate as usual, my man. Obviously, gambling it up these days more than I'd like to admit. Probably less than most people still. 40% on my BAM and 40% on BM. We're going to come back to that in a moment. Only 5 deep. Yo, baby. Let's get into this, okay? And dive into the positioning first and foremost and just talk about performance and obviously what's going on with these new positions at play. Because, again, I really want to fixate on just – it bothers me a lot, because I recognize this pretty early on, and I'm only just starting to take advantage of it now. But I feel like, these dividends, ETFs, and some of this stuff is going to be a little bit more boring in comparison. But still, over the last month, I should really get rid of this triple leveraged ETF, because it's going to skew these results. So let me just get rid of that so we can see clearly what the broader based ETFs are doing. Over the month, though, like nothing really happened. I mean, really everything that took effect kind of just really jumped in the last week when you see these like 3%, 1%, 1%. Because you got to remember the market over the month, especially the S&P, took a pretty wild dip. Not at the same incomparable to some of these dividend ETFs, but it's kind of just been a flat month for the most part, right? Like we kind of got up mid-month here, and then it's just been flatlining really ever since, except with the exception of the S&P, unless you kind of go back again to August here, getting into September. Take a look at the last 6 months here, and everything's kind of just falling in line. Again, the performance doesn't look that crazy. We're talking about 6 to 10% gains over a 6-month period is still absolutely astounding. But what gets really astounding is when you look at the year to date, because there's just a huge rally right at the beginning of the year. And the last rally that we've kind of really had that's been driving a lot of this is just kind of came out of this little dip here, right? And again, it's all comparable in the spectrum of like the time frames you're looking at here. But again, if you take a look at the year to date, it looks a lot different than when you take a look at the last 6 months, because 6 months, we're only several months into the year realistically, right? 7, 8 months. How deep are we now? We've got January, February, March, April, May, June, July, August, September. Yeah, so we're almost 9 months now. Holy shit, man, time is flying. So we're 3 months ahead of where my brain's at already. I'm kind of like like an egg fried against the wall here, apparently. But my goodness gracious, folks, if you look at the year to date, even still on the 6-month chart, we were barely tapping 10% gains. But then year to date, those 3 extra months at the beginning of the year really drove an extra 10% of gains in the S&P. I mean, you look at SCHD and VDY, and just there was so much action at the beginning of the year, and we've gotten very stuttery just kind of toward the latter half. But what isn't getting stuttery is these dividend ETFs, and that's what I want to talk about, because I don't know what way the S&P is going to go, but I am very much speculating on what's going to happen with the lower half of the market and interest rate sensitive stocks, because obviously we take a look at the Canadian markets and we use this as a parallel to the US markets. There's a new sector that most people, well, not a new sector, but a sector people don't really look at as much. And you zoom in here, and this is the real estate sector here, folks. And something very peculiar happened this week, only into the second, or are we on the third interest rate cut at this point in Canada? I think we've cut about, I don't even know, 0.5, 0.75%. We've cut only a little bit so far here. And look at what's happened to these real estate investment trusts. And I know there's a lot of RioCan lovers out there. Canadian Apartment Properties is up 6.5% just this week alone. That stock didn't do anything for like a couple years. You look at VRE, which represents the broader Canadian real estate market, just in this ETF, is up 5% just in the last week. In the last month, it's up 10.8%. Year to date, 17%, but none of those gains really happened until we started. So this was like the sniff out into interest rate cuts. This was people like being all gung-ho, like, oh, interest rates cuts are coming, right? And then interest rate cuts actually started to happen. Obviously, this leveled off a bit. People kind of lost their enthusiasm, and then more interest rate cuts came. And this thing has just gone parabolic for the most part. For a boring sector like this to jump 25%, I mean, just think about that. The entire Canadian real estate market that's publicly represented in this ETF jumped 25% just within a few month time span. But when you look at the 5-year, right, like very boring, very, very boring. It was very steady Eddie coming up to the pandemic. And then ever since the pandemic hit, the real estate market has been in complete turmoil of volatility. But it just blows my mind that like the speculation around interest rate cuts and the effect that it's going to have. And I'm so curious to how much of this is getting priced in. And obviously this is where we start placing our bets, right? Because we were trying to catch this a bit early on. I think it's too late to be buying this in Canada. Maybe not too late. There's still going to be a lot of recovery in REITs, but I just feel like these massive, massive spikes are really pulling forward a lot of expectation in, what's going to be a slow grind to cash flow recovery, because it's going to take a good, several months, maybe 4 or 5 quarters for these companies to really start seeing the effect of interest rates. So it's obviously pulling a lot of that cash flow ahead, and that'll be priced into these stocks moving forward. Like, we're not going to go back down to where we were. It's not going to happen, right? Like, there's going to be some base built in here. But then again, we look at the US, right? And that's where I'm starting to pay attention. And I told you guys, like, VNQ was a great recovery play, and it has barely scratched the surface of what we're seeing in the Canadian markets because we haven't seen any interest rate cuts yet, right? So this is the iconic bet that I'm trying to make. Like, we are just on the broad scale of things starting to see a little bump up. It's actually kind of similar, I guess, from the very, very lows there of 25. But you got to keep in mind, like, this just doesn't seem as like meteoric as it should be. It should be so much more substantial, because typically anything that happens in Canada, happens like, double, triple, 4x what happens in the US. So I'm very curious, because I guess we're about 15% away from the all-time highs on VNQ and comparable to VRE here. How far is VRE off its all-time? About 8%, right? So they're kind of trading closely in line, I guess, to some extent. But again, I still feel like the US, I don't know, I'm just kind of getting this feeling in my gut that those interest rate cuts, as they come, we should see some higher cuts. But I can't like take a bet that's going to make me 10 or 20%, because I don't want to hold these sectors long term, right? So I don't know. This is going to be one of the most fascinating things I think we're ever going to see happen No one really wants to talk about it. I know everyone's kind of caught up in the Nvidias of the world and the AI hype and all that stuff, but these are very boring sectors, folks. These are sectors that affect your daily life. These are sectors that have so much more importance on the global economy than Nvidia has right now, to be honest. I mean, Nvidia is trying to affect Meta and Tesla so I can generate images, which, by the way, if you haven't been using Llama there, I mean, it's beautiful. Me and the wife are actually just dicking around with it. And if you guys haven't used Llama yet, I wish I could share with you like these cool images. I was like, a god hanging over the stock exchange, raining money down. And we were messing around with it, like an eyeball flying a kite as a character at a park. I mean, this AI stuff is super cool, right? But it's not really revenue generative. And right now it's really not affecting people the way the market is making it out to be affecting people. I mean, realistically, like, we're using AI in our job. It is an inevitability that AI is going to be replacing my job at some point, but it ain't happening yet. And Nvidia is probably not affecting your life that much yet. Real estate, on the other hand, is highly effective with these interest rate cycles. So it's very intriguing, right? It's a super intriguing conversation around these interest rate cuts. Matthew said it seems to be a coin flip on if rate cuts will be bullish or bearish right after the rate cut decision. So far in Canada, it has been very bullish on the rate cuts we've had, but 25 might be an optimistic soft landing view, where 50 would be a little concerning for a recession. There are even deeper narratives that could be bullish or bearish, so it's possible that the market coils after the FOMC meeting, building up for a big move that could go either way. Even historically, rate cuts have been a coin flip for very bullish bears. I think historically, from what I've read, it's mostly bearish, because typically anytime they're cutting rates is because like an economic disaster ensued, inflation, 2008, blah, blah. Like, I mean, it was always a horrific event. So usually the market toppled on interest rate cuts. However, I don't feel like that's the same circumstantial, evidence. I don't think I think the economy is far stronger than people want it to be, because people want to be bearish as hell and they just can't seem to wrap their head around why the market just keeps going up. Earnings are still relatively strong, though there's overvaluation. But if we use Canada again as kind of the bellwether here, Canada has been booming right now on interest rate cuts, which is kind of shocking. It's peculiar at best, right? And it's very interesting. So I don't know. Like I said, I'm gambling and placing my bets, but obviously I think in the spectrum of a base understanding is the real discounts in dividend stocks and interest rate sensitive stocks, for the most part, are starting to plead away. I mean, we're not seeing the record yields we were seeing. I mean, remember like Royal Bank, for example, or even JP Morgan. Like, take a look at these two boring bank stocks, right? Royal Bank this year is up 25%. The largest company in Canada somehow rallied 25%. If you bought the October lows, you're up 54%, and you would have locked in, I think, closer to like a 6% yield on this guy, a 5 or 6% yield, which historically Royal Bank has never paid out. You go look at something like JP Morgan, right? Like, these companies historically are very just boring companies. And I mean, you look at the historic runs they've gone on. I mean, JP Morgan's up 18% this year, right? When these stocks took a massive plummet, that's when these were dividend buys of a lifetime. I mean, you go back to 2023, if you bought that dip, I mean, you'd have been getting almost a 5% yield on JP Morgan, and you'd have over doubled your money in just like a year and a half, 2 years. I mean, this is crazy, right? So I'm not chasing individual dividend stocks. I just look at this, and I've been talking about it on my channel for those of you that buy individual stocks. I mean, same with my parents. Like, I own some individual stocks. My parents own some individual stocks. My parents more dividend oriented invested, but look at like British American Tobacco. Look at the tobacco sector. I mean, if you were looking for yield, this was a great place to come. And look at what's happened this year. And I don't know why. I don't know if it's the interest rate sensitivity, if people are speculating. I mean, what happened to Philip Morris? Why did Philip Morris decide to hit an all-time high, something that it hasn't done since 2012? 2012, nothing for decade, 15, almost going on 20 years. What happened? Why these industries now? That's the question that I'm kind of asking myself. Like, why are why are the more riskier sector stocks exploding right now? And my only speculation comes back to money market funds, that people that want income, people that are looking for higher income. So let's just presume you're a person that is a pure income oriented investor. And you're like, I'm making 5% right now, but that's going to come to an end. if I'm going to go to the market and I'm going to look for high yields and I'm an income oriented investor, there's a good chance that I'm going to go look for the highest yields first because that's what they do, right? And I mean, they've been getting high yields for years now. So those people have chased, foundationally really strong companies that pay historically high yields, and those yields have now got gobbled up way earlier than I thought they would have. I mean, we knew it was coming to some extent, but like, I can't find another reason to explain why there's so many companies like this. I can point out dozens of companies that are small caps, mid caps, that are relatively foundationally strong companies for the industries they sit in that are now hitting all-time highs that just a year prior were paying out historical yields. It's such a peculiar thing to see going on in the market that is just largely not being discussed. So I find it super interesting. I bought RY in 120. Yeah. So there's a guy that ironically I should have listened to him. But there's a guy that I talked to. Well, then again, VDY still gives me good exposure. But with Royal Bank, I talked to a guy that was running a crypto company. I don't know if he's still running the crypto company or not. I don't know how that company's even doing, but he told me very specifically, he said, at any recessionary event, if there's ever another market crash, you're going to take all your money and you're going to dump it into Royal Bank. He's like, you don't want any other banks. You just want Royal Bank. It is the bread and butter of the Canadian economy. And he's like, and it always rebounds far beyond where, you think it's even going to go to. And, that's literally what we've seen here, right? Like a 25% gain. I mean, that's half the reason, VDY is popping off right now. You look at VDY, right? I mean, we're up 11.5% now. And it's all because I told you guys that TD and these banks will recover. TD this year to date hasn't done shit because of the endless negativity that it's been through. But in the last month, it's up 5.2%. I mean, that is a pretty intense run in just a week. So like I said, there's just a lot of crazy stuff going on right now. What do you think about the PE ratio on VDY? Honestly, I'm not really paying attention to the PE because the Canadian markets have always been relatively cheap for the most part. Because most of your money, 50% of it's just in the financial sector. And yet Royal Bank's trading at a 14 here. But what we're about to see is a really big recovery in the earnings because these companies are, again, starting to actualize. I don't know if I can pull it up real quick, but when it comes to banks specifically, I don't think it has as much to do with interest rates as it does with, because higher interest rates, banks will make more money. In a lower interest rate environment, banks have a harder time capitalizing on the cash that's in the banks. They just make more money. Interest income will always go up in a higher interest rate environment. However, they've had a backlash of weakening loans because historically, yes, I can make more money on higher interest rates, but the problem is all the loans that I previously loaned out, they're going to be renewing, and those people aren't going to have necessarily better cash flow than they did a year ago, but they're going to be paying probably 3 times more on that interest on that loan. So there's the problem that in lies, right, is that the quality of those loans have gotten a lot worse. So when the quality of the loans get worse, the bank by law, by literal rules that the Canadian government and the US government, they put rules in place to protect the banks from collapsing. And that is if loans get weaker, you need to put money aside to ensure protection in case they default. So if we go down and we take a look at where's the quick income statement here? I'll see if we can find it. So if you look on this income statement right here, this is the bread and butter of the Canadian banks and why they're going to start doing so exceptionally well. Provision for credit losses. That money they have to put aside isn't technically a loss yet. It's not money they've necessarily lost. It's just money they have to put aside in case they get the defaults. This money gets written off against the net income. So what we have here are companies, and almost all the banks in Canada have been doing this. They've been making record revenue. They have been seeing the revenue go up. Year over year, Royal Bank went from 38 billion to 42 billion. They've, in the last year, or this is the 9-month ending, from the year prior in 2023, they put 1.7 billion away for loan losses versus 2024, where they put 2.4 billion away. But for the first time in Royal Bank's earnings since the interest rate cycle began, we saw them put less loan loss provisions aside. And because they put less provisions for credit losses or loan losses aside, their net income started to go up. So if you take a look at their net income, it hit 4.7 billion versus 4.1 billion just the quarter before. So now all of a sudden that net income is going to start growing at a much higher pace than it historically has. So that's why these banks and these companies are now going to be trading at higher price to earnings multiples, because we're going to go through a period of earnings growth. And this was what I have been spewing for the longest time on my channel. And it's like, you take it or leave it, but my family's done exceptionally well investing into this stuff in their retirement. I am still a very boring S&P 500 kind of a guy. You pick and choose what you want to invest in, because obviously I'm a more historical, long-term cost average kind of guy. I'm really not trying to like over trade this stuff and really bet the farm on it, because I have such great financial exposure already. But I can really simply do this through VDY. And it's why I love VDY so much, because I would buy these stocks on an individual basis. Like, I would love to buy them. But the problem is do I want to buy 10 or 15 stocks? Not really, right? Because then comes the inline problem of I have to manage 15 stocks. But when I come into VDY, and the real beauty of all this is that this stock literally represents what I love the most about the Canadian economy. I used to own Enbridge. I used to own TD. I used to own Royal Bank. I used to own Bank of Nova Scotia. Some of these I didn't, like Manulife. I never owned. I did own Canadian Imperial Bank, but now I get to own all my favorite stocks weighted by the market cap value of the best dividend stocks. So Royal Bank at 15. So for every $100 I put in VDY, 16% almost goes straight to Royal Bank. And I'm super happy with that, because I believe this is not an end all be all solution, right? Like, VDY should not be your end all be all to investing. Just like I had a comment on SCHD, and this guy's like, SCHD's performance actually hasn't been that good. Like, calm down. It's like, yeah, I know it hasn't been like phenomenal compared to tech or the S&P. We're in a new market environment where I still think it's going to start to perform much better. And it is. It's at all-time highs. But I'm not telling you to put all your money and all your eggs into this basket. It would be stupid to do so. And I'm not a financial advisor. I'm a clown on the internet. Let's keep that right. So, what should I do? Should I put VDY or SCHD in my TFSA? Depends on how your money's allocated. I think you can own both of them. You just got to prepare to pay 15% withholding on SCHD. I own SCHD in my RRSP because it's just a better place to avoid withholding tax. And then I buy the S&P, and I would buy growth stocks in my TFSA. If you're buying US stocks, buy US growth stocks, because you just don't have to pay withholding on capital gains. And then, divvy it up into VDY. That's literally how I have my accounts adjusted. The S&P and VDY on my TFSA, so I get good growth, capital gains out of the S&P, a little bit of dividends, but at least I'm not paying that much withholding. And then I got VDY for income, and then SCHD in my RSP, just to avoid the withholding, because that's really going to add up over 5 or 10 years, reinvesting an extra 15%. I'm up 11% on my VDY. Yeah, I mean, we're crushing it, right? Like, it just hasn't done shit. And I'm always so perplexed, by how, again, I've been in the market long enough to understand the reality of chasing highs, and I just don't do it, which is why I've gotten very lucky with some of the stock picks that I have with Tesla, and some of my trades have really worked out this year, because I don't like chasing the highs. I mean, they could perpetually go higher, but look at NVIDIA. I knew people that were buying NVIDIA at the top, and then it dropped 20%, then it's up 20%. And where does it go from here? I don't know. But when you can find value, it's not going to be at an all-time high price 99% of the time. 99% of the time, I've seen people buying all-time highs in certain stocks, wrecked them. I mean, go back to 2021. I mean, look at that. Look at how many things hit all-time highs. I mean, how many people got screwed in crypto? I mean, there's so many things that hit all-time highs that people were just scammering into, like Palantir right now, for example, right? Like, I love watching it. There was a great time to buy it. There's people in our chat group that are up 300 or 400% on Palantir, but the people that are like on their soapbox right now, just spewing it to the world, it's those people that get in now that take on the most risk. And those are the people that get screwed. So, I mean, look at like VDY, SHD, all these companies you could have been buying over the last 10 months, but nobody really cared. Now, all of a sudden, everything money and all these people are like, holy shit, these stocks have rallied so much. These are great investments to get into. It's like, yeah, but where the fuck were you 10 months ago? The same thing with the guys that bought Palantir. Like, they should be saying the same thing. Like, where were you when this was at, $7, not when it's at like 35. Yeah, I appreciate it, brother. Would you buy VDY in an FHSA? Yeah, 100%. I'd probably go, for the first-time home buyers, that's a really tricky account, because it depends on how soon you want to buy a house. Because my big concern is if you're trying to buy a house in 1 to 3 years, I wouldn't really want to put that money in the market, if I'm being honest. I know we've had 15 years of like a straight run-up market. Could that continue? Sure. But if a black swan event ever hit and you have your entire like your money that you want to buy a piece of real estate with in 100% S&P 500, and we go into some black swan event that's like, maybe not necessarily like the dot-com bubble, but if we go into some black swan event where it's like, these wars tick up in Ukraine, they become, more globalized. I don't know. Something could happen where the market does this, right? Where it flatlines for a decade. And you don't want to be in that market if you have to buy real estate in the next 1 to 3 years. So like, even when I bought real estate, I liquidated my funds way earlier than I should have. But I recognize that like those funds weren't meant to ride market returns, because you don't know what 1 to 3 years really looks like. I mean, if you're in it for 10 years, I mean, obviously I would put all that money in VDY, VOO, but just be very careful. If I were you, if you're looking to buy a house, you can still get good GICs, I think at 4%. I would just, if you're looking 1 to 3 years out, get a cashable GIC, try and lock in a good rate for 1 to 2 years. And I would just focus on more stable returns and very stable investments in an FHSA, because it's a first-time home buyer's account. So just be cognizant of the time frame at which you need capital. Again, you might look ahead and be like, shit, I should have just put my money in the market, but you just don't know. And you have to really recognize you don't want to gamble with your money. And within 1 year, it's risky, man. I sank all my money into Aduro, you crazy bastard. Aduro Cleantech is still highly speculative, but it's still one of my favorite small caps. It is my favorite small cap realistically. And I still own shares in it. I got some pretty decent shares in it. I think I've got maybe, I don't know what the value is. I'd have to look. I think I'm sitting up like 5 Gs on this one right now or something like that, because I bought it like a couple years ago since we started talking about, I think it's almost been 2 years. Has it been 2 years since we've been talking about Aduro? I don't know, but it's done exceptionally well. It's on the forefront of commercialization right now. I kind of just consider these lottery tickets, so I would not sink all my money into this. However, it is an intriguing investment on the plastics recovery play. I currently split between VDY and, yeah, there's nothing wrong with that. Again, just be cognizant. VDY is pretty stable for the most part, but you never know. You never know. Like I said, a black swan event could hit, and you could be up shit's creek for a little while, especially if you want to buy a house. Is it possible to predict the market, but when you have held your stocks long enough, it's rather easy to see the pattern and have better insight into what buying opportunities could be? So yes, if you pay attention to the market, and this is the hardest reality for people to stomach, and we were talking about this because my uncles came down when it comes to being a gambling addict, because I'm sadly, like I won't get into it from a personal standpoint, but we know people that are gambling addicts that have pretty much lost their homes, people that are personally close. And sometimes it's hard for people to recognize, this is what Dave Ramsey says too, right? Like sometimes it's better to put your money in mutual funds or hand it off to a money market manager, because yeah, you're going to be paying probably up to 1% in fees. But if you can't manage your money and you're playing with it and you're pulling it in and out and you think you can time the market, eventually that's going to bite you in the ass. And it really comes back to like, if you miss the 10 best days over the last 20 years in the market, you've missed out on like 50% of the returns. So like when you're looking at playing stocks like I am, and like, you're really dabbling down into it, you have to remember my fucking job is I sit here 5 days a week and I watch the markets. And I still am scared shitless of making the wrong decisions. And I'm super hyper particular about how I manage my portfolio. And I'm not jumping in and out of the market. Even in the 2022 crash, when I liquidated my entire portfolio, I immediately put it all back in the S&P 500. I wasn't going to sideline shit. I knew we were heading into a tough market, but I didn't know what the fuck was going to happen. And neither do you. So like, when it comes to placing these bets, you really need to play it in a way where you're comfortable and you're confident and you're not going to risk more than you're willing to lose. Because at that point, you are statistically gambling. You're just trying to gamble in a way where the odds are more in your favor. And that's the casino of the stock market, which is why I hate real casinos, because the real casino, the odds are ever in their favor. And that's why they give you perks to come back, because the longer you play statistically, the more likely you're going to lose. Whereas in the stock market, you can find something where you have an edge, a statistical edge. This is why you want to pick industries you know and understand, and you make those statistical plays. That's why I'm buying DRN, right? Like I'm trying to triple leverage the real estate market in a short period of time, because I think if what we're seeing happens in Canada, happens in the US, I could easily make a 50 or 100% gain in the next 3 to 6 months. That is a statistical bet. Now, if it bites me in the ass, which it very well likely could, I'm only going to lose like 5 or 10 Gs. I'm still buying it. I want to buy more next week. I've got about 5 Gs sitting in it right now. Is that how much I have in there right now? I mean, I don't have as much as I want. In the gambling addict in me really wants to like put like 10 or 20 Gs in it like yesterday. But I have to recognize that I could be very likely wrong, and it would be stupid to just throw endless amounts of money at this. But strategically, the gambling devil on my shoulders, like, hey, like this seems like a logical bet. Unlike anything else I'm seeing in the market right now, it makes sense to me. It speaks to me. So I got about $4,800 in there. My average buy is 1275. It's now sitting at 1375. 258 shares. Let's see what happens, right? But again, I've been wrong. I have been wrong before, but I cut my losses as well. When I realize I'm wrong, I sell out pretty quick. I'm sure you guys have seen my flip-flopping over the years. No one knows what the market will do next. Just dollar cost average. Yes. Again, statistically, the longer you're in the market, the more likely you are to have a return, which is why we cost average into long-term broad-based ETFs. Hey, Kyle, what's your opinion on covered calls and cash secured puts for generating income alongside dividend cash flow? I recently started and I'm having great results. Yeah, actually, there's a guy in our chat group who's up a stupid amount of money writing covered calls. Best thing you can do, especially if you can write it against something like SPY or stable investments. I do not like covered call ETFs. The management fees are too high. Don't be giving somebody else your money for something that you can very easily do at home. And it's been a very successful strategy for him this year. He's done very, very well. And I mean, that's what everything money wants to do, right? Like you can buy SCHD or SPY, write puts against it, or covered calls, the right puts, but whatever. And you can just collect the premiums and, you can do pretty well with that and raise your dividend by probably a few extra percentage points if you're lucky. What made you choose DRN? I don't know. Sometimes the stars align. I own VNQ and then I flip-flopped out of VNQ because I just didn't want that much real estate exposure. So I bought the utility ETF because I just felt better about it. And like I said, I own real estate in Toronto. The wife owns RioCan. We have too much real estate. However, when somebody was talking about, I don't know if somebody mentioned it. I don't really remember how it came across my desk, but when I looked at it, I was just like, I don't know. It just hit me. That's how investing works. I don't know. You learn all this shit and out of nowhere, you just see something and you're like, this makes sense. And then usually like within a day I'm buying it because you want to own it. So you're paying attention to it, even if it's just a little bit, just to get your interest up. And then if the interest continues to grow over time, I just keep buying. But again, like the drop of a dime, that opinion can change. It's like me with Tesla. It's like I have my love-hate relationship with Tesla. Yeah, I think it was you. Was it you that got me into XLU? Because I think when one of you mentioned on the live stream XLU, I immediately sold VNQ and I flipped immediately into utilities. Because I don't know, you guys just say things and sometimes like you think you're aware of everything, but you're not. Like I've been aware of utilities, but that doesn't mean like that's where my focus was over the last 6 months. I mean, I don't know. It's just investing. Sometimes you flip-flop into some decisions and sometimes it works out and sometimes it doesn't, right? But I appreciate you guys. I mean, you guys have led me down this path. So it's kind of intriguing to say the least. It's kind of like a little social experiment here. Yeah, I don't know anybody else. I'm really shocked at how little people are interested in the real estate market right now. So it's going to be fascinating to see how this pans out from two spectrums, because not only is Toronto having a flood of studio apartments on the market, prices haven't come down that much, but I'm so curious to see what this condo that we bought is going to be worth, because we bought it for almost exactly fair value. Because obviously we had like an appraisal done on it and we paid almost exactly fair value for it. I think it was like a couple grand discrepancy and difference. So I'm really intrigued to see once interest rates go down, what happens to Toronto real estate and what happens to this condo. It's going to be fascinating. For something like ZSP, do big annual buys to dollar cost average or monthly buys. Recently subscribed to one of the content. As a 33-year-old, this form of investing is light at the end of the tunnel. Yeah, no, for sure, right? So, sorry, you're saying, do you do big annual buys? I'm a lump sum investor for the most part. I do cost average, obviously, and I buy stocks every month. But usually, when I buy stuff, I tend to do it very aggressively. And I don't know, you can do whatever way you want. If I have cash, like I have a hard time sitting on cash. The only thing that keeps the cash in my portfolio is the fact that if I pull too much cash out, then you start getting those monthly fucking fees. And I can't justify the fees because, I looked at the returns that I could make averagely, and it's really not that big of a difference to the fees the bank will take from me. So I'd rather just keep the minimums, which in Bank of Nova Scotia, I need 3,000. In my corporate account, I have to have 4,000 US in my US account to avoid paying like 10 or 15 a month in fees or something stupid. So that's the only thing that keeps my cash laying around. But, for the most part, I'd probably be addicted as hell and just try and throw every dollar I have into the market. because that's what's worked. Price of studios are ridiculous. Yeah, but everyone is annoyed with how expensive Toronto real estate is, but Toronto's the hottest place to be, baby. I'm surprised I've been able to make it here. I'm shocked, to be honest. But I mean, look at it. Toronto is becoming like New York. Toronto now has the most busiest highway in North America. We have the most congested city in North America, which blows my mind compared to New York or LA. It's kind of hard to wrap my head around it, to be honest. But we have the fastest growing population of the G7 countries. Canada, I mean, everything about Canada really screams that real estate should, in a lower interest rate environment, continue to perform exceptionally well. And again, if you think real estate's expensive here, go to San Francisco, go to New York. I know people in New York right now that have to split an apartment, a really small apartment, between 3 people, and the apartment rent is like $7,000 a month. I thought $3,300 for a 2-bed condo in Toronto was a lot, and that's CAD. I mean, he's paying I think US. Toronto's becoming like New York. It scares me. Yeah, I love this city a lot. It's changing way too much. I don't know. It's like everything. You kind of have a love-hate relationship with it, right? The only thing that keeps me here is family, and I'm very thankful that it kind of comes back to that idea of New York. If you can make it in New York, you can make it anywhere. And I'm just in my head, I'm like, yeah, it's fucking expensive, but we can afford to make it work. We're not going beyond our means. 30% of our income isn't going toward our housing expenses. Like, we're in a very healthy financial position to do this. So I'm very thankful, because when I look at when we were just in Europe, I mean, everyone's like, Italy is so expensive, but compared to Toronto, Italy's cheap. Just from a housing standpoint, New York City is very expensive. Yeah. I love that saying. I can't make it in New York. I am not that rich. I can make it in Toronto, but Canadian definition of rich is a little bit different. What's the Canadian dollar doing right now, actually? Because I think I'm also curious to see if the US dollar drops. That's another risk with my US investments too, I'll finish up with a few things here, but yeah, one of the big risks is typically when they start cutting the rates, the dollar should rally, right? So I mean, look at this big spike in the Canadian dollar. It went up couple percentage points since they started cutting rates. We're still historically low, but USD, yeah, if we look at the DXY, I'm very curious to see what happens here because, the only reason the US dollar gained so much momentum was because people were running into so much cash. And now, as you can see, it looks like people are steadily moving away from cash back into equities or into other investments. And the same thing that happened to Japan. I guess Japan had their little meltdown. So, I mean, we're seeing money move away from the US dollar now, which if I had to guess, this should be a trend that continues. As soon as we start cutting interest rates, we should start going back down, which means Canadian dollar is about to go up, which means it's probably better to keep some Canadian dollars if you live in Canada, because, yeah, this could really kill some of my returns. But this comes back to the point that I keep a lot of my money in US investments and US accounts. So let's say I make money on DRN, but the US dollar drops, meaning the Canadian dollar is going to go up. Canadian dollar goes up by 5 or 10%. I could lose 5 or 10% on that US dollar exchange, which sucks. I mean, that's a big fucking, punch to the face in a return. If I make 10%, I'm losing 5% just to the exchange. However, I'm not going to pull that money into Canadian dollars. That's the brilliancy of it. I just leave it in US. I invest it in US. But this is something that's going to be a real concern for a lot of Canadians that own VFV. For those of you out there that do invest in the Canadian counterpart that automatically convert dollars like VFV, look at how well this did. This is up 21% this year. VOO is only up because VOO is only up 19%. So you've made an extra 3% on the dollar exchange just this year. But guess what, baby? That's going to change. And that's the risk with, currency exchange. The S&P can go up 10% next year, but if the US dollar drops the Canadian dollar by 5%, that 10% doesn't look so great. But anyways, folks, I've been rambling here for a little bit. I want to finish up with a few things and just some more lighthearted stuff that we can get into. I wanted to talk about PPC Ian in the oil industry because, he's buying into oil now, which I find very interesting. And I kind of have a bit of an affection for PPC Ian. No homo, but in the way that this guy really looks to industries that aren't doing well. I give anybody credit that wants to go where nobody wants to go, and he wants to go into oil and Chevron right now. So I gotta props PPC Ian, because I love seeing people spearhead industries that everyone's like, I'm not touching that, because that sometimes leads to exceptional rates of return, right? But few more questions here. What model car do you drive now? Actually, I think did I not get to that question? Somebody was asking me about the auto industry. I don't even think I went down this rabbit hole yet. Hi, Kyle. What do you think about the auto sector in general? Some car companies like STLA are trading with PEs around 4. Yeah, I find it really interesting because GM and a lot of these auto companies are outpacing Tesla with performance, which is kind of shocking. But here's the reason I will not buy the auto industry. I mean, you look at the year to date, almost all these auto cars companies, except for General Motors, are in the toilet. You made no money this year. Over the last year, none of these auto companies have made money except for General Motors. Over the last 5 years, somehow Tesla's gone absolutely parabolic. If we remove Tesla, however, let's look at these other companies over the max. If you look at the max return of a lot of these companies, with the exceptions of Toyota, I mean, the US is just abysmal. I mean, these car companies have been around for quite some time, right? Let's just keep it on the 5-year scale. Look at the 5-year return of these car companies. I'd avoid it like the plague. Avoid it like the plague. Forget oil. Oil's cyclical. I get it. You can buy oil. Buffett loves oil. But I would avoid the car companies like the friggin' plague. And then just to finish up on one more note as well, because some of you guys, I just want to give you a clue to who you guys are before I finish up. And then I'll talk more about my personal car, because sometimes we get into the car conversations. But I think this is super interesting because you guys seem so dividend oriented that, I should probably keep making more dividend videos. But I like that I can talk broadly about the US and all these different stocks, and you guys are still intrigued by it. Because a lot of you guys are watching Brandon Beavis, Passive Income Investing, Daniel Pronk, the dividend guy. A lot of you guys are like Ari Gutman. He's a cool dude. There's a lot of neat guys in here. Dividend Bull. It's neat seeing the channels that you guys watch. And I want to show you something really interesting that I'm going to try out too, because I don't think people realize YouTube is doing some really interesting stuff. So it's neat seeing the videos you guys watch, the times that you guys are typically on YouTube. It's fucking weird that I get to know all this stuff. It's really weird that I get to know, most of you, 40% of you aren't subscribed. Almost 70% of you are from Canada. At least 5% of you are from India. 93% of you are male. I got 7% female following. We've got 25% of you are roughly my age, give or take, 25 to 35 years old. So the smallest part of my audience isn't even the same age I am, or a quarter of you, which is crazy. 26% of you are 35 to 44. And I was shocked to see that there's over 6% of people are 65 plus. I find that super fascinating. My audience, I mean, if you go back to my channel a couple of years ago, I remember looking at this and my audience was a lot more squished. I found it was a lot more of like 25 to 44-year-olds. I feel like my channel's broadening out, which is probably a good thing, right? And I also find it interesting because if you go into inspiration on YouTube, YouTube is actually telling me what to make for videos now, which I find fascinating. And it tells you what people are looking for, like best dividend stocks for passive income, best monthly dividend stocks to buy now. And then it's like, make a short, crypto passive income, 8 strategies for thriving when stocks drop, financial ratios. So it's interesting that YouTube's starting to really recommend a lot of this stuff. I find it relatively interesting. Yeah, hit that like button, folks. I appreciate you stopping and show us your revenue. Oh, you'll be so disappointed. Here, let me make sure I'm not bringing up anything private, but I'll show you the revenue. Let's take a look here. So here's my revenue. Super boring. I have made $362 so far over the last 28 days. I think for April, I made $467. It's usually around $400, give or take. Right now we're in a slow period. August, September for my channel usually does the worst. And then once we get into October, November, December, ad rates start going back up because people are, again, paying a lot more for ads. Because the holiday season's coming around, there's more promotion, so you get higher ad revenue. That's why always at Christmas time, that's why we have Vlogmas. I guess, have you ever heard of Vlogmas? All the vloggers, they start hammering content because that's the time to hammer content, right? But yeah, I couldn't make a living off YouTube AdSense, and I think people largely underestimate how little YouTube pays. I mean, if you look at my RPM here right now, I'm getting about $6.05 per 1,000 views. Mr. Beast is probably getting $2 to $3, probably nowhere near close to this. You're basically getting if you think of it this way, ad share for every just say for every 1,000 views you're getting, I think I have to split this with YouTube, so I get half of that. So I get like $3 for every 1,000 views that I'm bringing in, give or take. So, I mean, this Canadian stock video, for example, has made me $20. If we click on it, how many views does it have? Yeah, it's got about 3,000 views. So that's pretty good. Actually, is the RPM actually the RPM might be the net that I'm getting. I might be miscalculating that. But let's just take a look here. 29 divided by 20, or sorry, 20 divided by about 3,000 views. I'm doing that wrong. Sorry. 20 divided by 3 is, yeah, so that is right. Okay, so yeah, never mind. The RPM is the amount that I walk away with. So I'm getting $6 per thousand views. Mr. Beast is probably getting about $2 to $3. The financial and the stock market niches pay the highest. You'll never see RPMs like this on gaming channels or anything like that. But that just tells you, like, people like Meet Kevin, for example, and let's just use him as a really intriguing example here. So if we go to Meet Kevin's channel, you calculate exactly how much he's probably making, which is really fun. But let's just take a look real quick. So on Meet Kevin's video, let's say his last video had 174,000 views 2 days ago, right? Which is crazy. So 174 times $6, if he's getting roughly the same, he's making about $1,000 on that video. So it's probably less than you thought it would be. But let me tell you, I'm not going to tell you on this video, obviously, but I would look into ads. I make a lot of money, and it has nothing to do with AdSense. Because, man, I can do one sponsored video and make a couple G's for like an hour's worth of work. Sponsored videos, whew, baby. I mean, you want to talk about real money. That's why everyone does, like, I mean, that's why I can't imagine what Meet Kevin makes off his his own affiliates, right? Like, he has his own, his own courses and all that stuff. Meet Kevin probably, I don't know, he makes a lot off AdSense. I mean, the guy's posting every day, making probably about $1,000 a video. So you do the math here, $1,000 a video. In the last week, he's done 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, $12,000. And then he's probably raking in another 10 or 20,000 off, everything else that he's doing. Rapid Shadow Legends, Raid Shadow Legends. Yeah. You watch those gaming channels too, eh? You're seeing those ads. Can you see? I watch a lot of crime documentaries, all kind of creepy. Yeah, my mom's into the crime stuff too. Hey, Kyle, 2 quick questions. What do you think of CNR right now? And what do you do if you had Palantir position? I would take profit. So when it comes to CNR, we'll start with CNR and then I'll finish up with this. CNR. So Canadian National Railway is always a foundational company that you can buy into. And just like any company that if you love it enough, you'd be willing to buy it at all-time highs and then cost average into it when it goes down. And Canadian National Railway is a company that has a long-term track record. It's been around forever. It's super stable. It's got moats. It's got everything you want. It's like your Apple of a different industry. Pays a good 2% yield right now. It's a very nice yield for it. It's trading at around, fair value, a little pricey because the earnings have been a bit rockier for the last 5 years, a little bit more volatile, but stable. These are the kind of companies you buy to add stability to your portfolio. It's kind of like the utility sector. I wouldn't be buying this thinking that I'm going to outperform the market, but I would buy it if I just wanted to add, like, it's like me buying utilities. I'm not buying utilities to outperform. I think they're going to do well, but I know they're going to offer more stability than the S&P is going to offer. And that's all I want, income and stability with growth. It's a hard balance to find. So CNR is what I would call a stabilizer. Palantir, on the other hand, because it's a company with less of a track record. Well, it's been around for a while, I guess. Palantir has actually it's been around for quite a little bit. I don't think it's been public that long, but I think it's been around since, is it earlier 2000s? Palantir has been around for a while. However, Palantir to me is more of a stock that I'd trade, like Tesla. Like I hear a lot of people right now saying, oh, 10 years out from now, you can easily double your money. It's like, it's kind of priced in the next 5 to 10 years, unless it does something really explosive. And I've talked about this in my videos, right? Like they need to get 30 to 50% growth to justify today's value. There's just so much risk. I mean, think about how expensive Palantir was here. Think about how expensive it is now, but imagine how expensive it was when it was at all-time highs back here. So Palantir, like, it is not justified its value yet. For it to be trading up here is crazy, in my opinion, unless it does what Tesla did, and it just has explosive growth. I don't really care. Like I said, I don't understand software companies well enough. It's why I didn't buy Shopify. It's why I don't buy Constellation Software. But I mean, you compare Palantir to any other software company, and it makes everything look cheap around it. It makes Constellation, Shopify, Adobe. There's so many companies out there. Google looks so much cheaper. Like if I was going to pick a stock today and I want software, Google all the way. Google's stupid cheap right now. I mean, it's got some headwinds ahead of it, but it's still growing and it's still very favorable at its value. Palantir, I just don't get it at this value. It's crazy. So just be careful with it. If you own it, take profit. You know, I always recommend taking profit when you've gotten historically like crazy gains. If you make 100 bagger in less than a year, you take profit. It's just a rule of thumb. Because like I said, you could end up in a Tesla situation, right? Where Tesla like pulls forward so much value that it does nothing for 10 years. I mean, Tesla's how deep now? 2021. I mean, it hasn't done anything since 2020. I mean, we're 5 years deep into this now and nothing's happened. And the same thing happened a decade before it. Like Tesla does nothing for 10 years because it pulls forward that value. So you got to keep that in mind, right? And it's not a fun thing to have happen to stocks, but when you have hype stocks, it's an inevitability. I think it's inevitable that hype stocks you get overvalued and they eventually pull back or they don't do anything. Tesla's a hype stock. Palantir's a hype stock. I mean, you go back to 2021, a lot of crypto hype, a lot of small cap hype. You don't want hype. Hype is something you want to come after you've bought it, not before you've bought it. I mean, I'm looking to find some industrial construction stocks to support AI. That could be interesting. New and loving it. Thanks, brother. Have you heard of new U.S. Democrats and Republican ETFs? No, but I will take a look because the election plays could be interesting. Do you like XCQT? Yeah, it's not terrible. XCQT is what, the broader based ETF, I think. Yeah, this isn't bad. I think this is more of like a core holding. If you just want like broad diversity, XCQT owns a lot of stuff, doesn't it? It's like a broad-based ETF in Canada. You get like US broad-based exposure. What are the holdings in here? Yeah, this is good. This could be an end-all be-all stock. What's the expense on it though? Hopefully the expense ratio is not too high. Where's the expense ratio? Management fee. Yeah, 0.15%. That's reasonable. Or sorry, 0.2. It's a bit high, but reasonable. I mean, it's not bad. You could just buy this and be done with investing. It's a pretty straightforward ETF. Otherwise, folks, hi Kyle. I saved by buying you used tires and rims. Jesus Christ. Oh man, you've been around too long. Yeah, BMO even shot up. BMO is in the fucking gutter, man. It was getting shit on for a while, and like, yeah, even it's even starting to come back off that low. It's up 5% from that last dip. We'll see if it breaks trend, but time will tell. Anyways, I could go on for days, folks. I appreciate y'all stopping in. Just a quick conversation tonight. Stay cool, stay awesome. Peace.